Hello and welcome back to our channel. My name is James and today we will be talking about support and resistance levels, a true staple for any technical analysis trader or anyone trying to read market structure. We will keep everything condensed and simple while including some good examples of when support and resistance can prove to be valuable tools when deciding on a potential exit for a trade or an entry when prices may look to continue or reverse. We will also show you guys some examples of when support and resistance areas are likely to fail to give you a better understanding of what to look for, as not all support and resistance levels are created equal. Also, feel free to check out our other videos, including our weekly news series, in which we deep dive into what's been driving prices throughout the last week. Before we begin, a disclaimer for you. Forex trading carries a high level of risk to your capital, and you should only trade with money you can afford to lose. And remember, the content we produce is for educational purposes only. We have also marked timestamps on the video to help you guys navigate to different parts if you so please. However, we do advise you to watch the entirety of the video. If you do enjoy our content, please do like, comment, and subscribe. It'll help us with those YouTube algorithms. Now, we know that prices are driven by the market forces of demand and supply. When the sellers are in control, the price moves down. And when the buyers are in control, the price moves up. However, we also know that prices don't just trend straight up or down forever, without pullbacks along the way. So I'd like you to imagine that these levels of support and resistance are acting like magnets, and the price level interacts with these levels like so. As you can see from the hourly Kiwi dollar chart, we have the absolute capitulation of the markets in March 2020, as the world went on shutdown because of COVID-19. Since it recovered, there has been resistance around May 2020, and price has 3 bounces off of this key horizontal level that we have here. Price can't break above it until the 4th attempt in June, and once it does break above it, it comes back down to hold around the previous resistance. It then becomes a level of support and pushes off from this key level very quickly. We will go over other examples where resistance changes to become support later on in this video. These levels can be significant across all asset classes and across any time frame that you wish to observe. Now that we can see resistance and support, if you imagine that resistance acts almost like a ceiling for the price to break above, and when the price gets to a key level that it struggles to get through, traders call this resistance. On the other side, support can act like a floor for the price to fall through, and when prices are falling but can't manage to break through this, traders call this support. It could help you understand these easier if you imagine them as a floor and ceiling as we've shown here. Let's take a couple of examples in the markets where support and resistance have been shown together. For our first example, we will take the FX pair, the Kiwi dollar. This chart shows the price on the hourly chart, and the horizontal line here was a form of resistance or a price ceiling. We've circled where prices come and test a resistance but failed to break this on 2 occasions in September 2020. But once price breaks the resistance in November, price comes back down to backtest the previous resistance to confirm it as new support. It happens again on 2 occasions, and once price gets a nice bounce off of the new support, it goes on to confirm a further bullish trend and sets new highs. This is a textbook example of an uptrending market where we can see multiple tests of resistance which gets broken, and then backtest the previous resistance to become new support, and prices bounce off these levels to continue upwards. In an uptrend, if you imagine that resistance on a chart gets weaker each time that it gets tested by prices trying to break above it. Well, let's take this example and compare it with chopping down a tree. As a lumberjack swings his axe to chop down a tree, it doesn't always work out with one swing of the axe, so price gets worn down like the tree, and with each push, it gets weaker and weaker until it collapses and fails as resistance. The exact same can happen in a downtrend, when prices try to break levels of support. Now, let's take an extreme example looking at the Dow Jones 30 on the monthly time frame. Here we can see in the midst of the COVID-19 sell-off in March 2020, where the price came down to bounce off a price level around 18,000, that price level was consolidating or going sideways for the longest time in the last 15 years, between 2014 and 2016. Before it acted as resistance as price struggled to break through it for 2 years. Then, once the price came back down to bounce off of it, almost like a magnet, it became a confirmation that this price level is now providing support for the bull market. Note that these are just examples to show that support and resistance levels can be formed on any asset class, like an equity market here, or the FX market as shown from our first example. Here are some key things to remember about support and resistance. The higher the time frame, the stronger the area of support and resistance. What we mean by this is that if the price fails to break a key level, either above or below multiple times, then this can cause the price to bounce and reverse on itself. Especially on a larger time frame. If there are multiple bounces off of a key level, this can mean that level is significant. For example, if you were in a long trade and approaching an area of strong previous resistance, you may want to be cautious and manage your risk, especially in the event of a reversal. The same could be said if you are taking a short position. Support and resistance levels are broken all of the time on lower time frame. Depending on the strategy that you are using, as a day trader, you will see prices cross levels of what we would call soft resistance or support. There is a stronger trend bias on longer time frame. It is good to understand the difference here. As for example, the pound US dollar chart has a range of anywhere between 80 to 125 pips in a day, meaning that you would expect more areas of soft resistance and support which gets broken in lower time frames compared to a chart with less volatility. Support becoming resistance, resistance becoming support. This follows on from our last point, but we need to stress how important this is. Let's take the Kiwi dollar chart again, zoomed out to show that this is trending upwards. Here we have a trend line which shows dynamic resistance and support, as it is broken a few times. Then we have the static resistance levels which price fails to break, then becoming support once these levels are broken. We can then see that once this dynamic support and resistance crosses the static support level, this is a textbook confirmation of a continuing uptrend. Price bounces from this key support level, and we see this happen again on the chart. Resistance becomes support, and the uptrend continues. This is for those of you who are unfamiliar with the difference between static and dynamic support and resistance. Trend lines act as dynamic resistance and support because they are moving with the price or following the general direction. A lot of traders use moving averages in their entry strategy, and this is another type of dynamic resistance. Then we have static resistance and support levels, which are the horizontal lines that we have drawn on the chart. These are static as they do not move. With a trend line, because it moves, goes in the direction of the price, as you can see in the chart, before the trend line crossed the static support for the second time, the upwards trend slows down, giving the trend line time to catch up. Then, once it crosses the static support and reconfirms the bullish trend, price bounces quickly off of these. We are just showing you here a textbook example of when you can combine both static and dynamic resistance and support levels to show confirmation of a stronger trend. In times of consolidation, it can get quite boring for us traders, as profits are more easily taken once we have confirmation of a direction that the market is heading in. When prices are constantly reversing between two levels, we call this a range, when there is support and resistance both acting together. Here is an example of what this looks like in the present. Here we have cable, pound US dollar, and on the hourly chart, we have been stuck in a range before a breakout to the downside. As we mentioned earlier, multiple bounces off of a level can show signs of a potential reversal. We know that pound US dollar has been a very bullish chart for this year. However, the uptrend looks like it could be running out of steam. There are so many different chart patterns and structures that prices follow. One trading strategy could not just solely rely on one singular indicator or one particular pattern. Support and resistance lines are just like any other. They would have more significance when combined with other indicators or chart patterns which confirm what you believe is already going to happen with the price. For example, Fibonacci retracement levels also use areas of support and resistance. And as we mentioned before, moving averages can act as dynamic support and resistance. Here are the FXX tips for this video. Here is something that you may want to think about when deciding which trade to take. The price travels at its strongest point when it is moving in a trend. In other words, if you can see a certain currency pair has been stuck in a range for the past few weeks, you may find that it is easier to wait until the price has broken through this range before taking any positions. It might be an idea to see what currency pairs have been trending and offer some direction in helping you with a higher probability of success on your trade. This will help your decision making on your entry and exits. You can use key support and resistance levels to help decide entry and exit points. For example, if we look at the first time the trend line crosses the static support, this would have been a very good entry, using both supports to determine when to take a long position. Then, when deciding to exit a trade, another key level of previous resistance could have helped you decide on an exit strategy. This could help give you peace of mind when your trade gets close to those key levels, so you don't need to worry about a reversal. If we have another look at the pound US dollar chart here, we go into more detail on the range. We can see on the hourly time frame that these are areas of soft resistance and support, with price getting to the top of the range around 4 times and to the bottom around 4 times in the last month. It is important to know that these ranges can get bigger and smaller. The price already peaked through this channel, and the time that this range stays at this size can't be relied upon. That is why having a good understanding of the overall market direction from a longer time frame is always a good idea, to not get stuck into taking a sell at the top of the range and having it break through, or vice versa. Sentiment does play a huge role in this market, as we have seen. And with Boris Johnson confirming that nightclubs won't be opening for another month, along with some weak buying pressure off of a long bull run in this chart, you could start to see some weakness in the pound, as we have broken out of this range to the downside. This is where you should decide whether the strategy that you're trading works better with ranging or trending markets, as each will have their own characteristics, and other indicators can be brought into play to help with entry and exit points. If you have a good bull market strategy, it could be a good opportunity to look for areas of support for entry points. In a bear market, looking for areas of resistance could be good entry points. But in times of ranging and indecisive market conditions, like we have been in the crypto and stock markets as well as forex, it can be difficult to forecast where it will break. Sometimes, a bit of patience to see how things play out could be the most useful for you, and not force a decision that didn't have to be made. I believe that wraps up this episode on support and resistance lines. We hope this provided you with a useful insight into them, in as short of a time period as we could get it. If you enjoyed the content shown here and would like to see more, please let us know, and stay tuned with the channel for more useful Forex content.